Hey everyone, welcome back to Corporate Decoder. Today we're diving into a Form 10K, which is a yearly financial report. And let me tell you, this one's a bit like a roller coaster, full of twists, turns, and a few unexpected drops that might make you clutch your popcorn. We'll break down what's really going on behind the numbers. We're talking about Argo Group International Holdings, a company that's been through a lot recently. They used to be based in Bermuda, but they've moved to Delaware. Think of it like switching houses, but instead of just packing boxes, they had to deal with laws and regulations. This switcheroo called redomestication is something to keep in mind as we go through this report. Argo Group is mainly in the business of selling insurance, specifically what's called specialty insurance. This isn't your everyday car or home insurance, it's for unique situations that need special knowledge, like insuring a construction project or protecting against environmental risks. We'll be looking at three main parts of their business: casualty lines, specialty lines, and runoff. Think of runoff as the stuff they're trying to get rid of, like old insurance policies they don't sell anymore. But before we really dive into the numbers, there's something important to consider. The report has what are called forward-looking statements. These are basically guesses about the future, and Argo Group is very clear that things might not go as planned. Things like changes to regulations or economic slowdowns can impact the business. One big factor in the insurance world is how reliable your backup plan is. For an insurance company, that backup is reinsurance, which is insurance for insurance companies. If a company gets hit with major claims, it needs to know its reinsurers can pay up. Argo's report shows most of their reinsurance is with companies rated A or better by AM Best, which is a good sign. However, almost 1/5 of their reinsurance balance is with companies rated A or better by AM Best, which is a good sign. However, almost 1/5 of their reinsurance balance is with companies that don't have such a high rating. This means they could have some risk when it comes to collecting on claims. Argo Group has employees in the US and in other countries like Bermuda and Italy. Companies need to make sure they can keep those skilled employees, or it could affect their financial situation. There are a number of specific things that could go wrong, and the company highlights these in what they call risk factors. Insurance companies have to deal with all kinds of risk factors, but here are a few. Economic inflation could cause claims to be more expensive, or they may not be able to get reinsurance when they need it. It all boils down to the idea that the business could be affected if they can't pay, and that's a legal and regulatory risk. Another big item is cybersecurity. Technology is critical for insurance companies, so cyber attacks are a real danger. They are worried about data breaches and ransomware, not only affecting them directly, but also their third-party providers. Now, let's talk about who actually owns Argo Group. As of March of 2025, there were only 13 shares of common stock outstanding, and all of them were owned by Brookfield Wealth Solutions. The company, as of June 2024, is not traded publicly on the stock market. Alright, let's move on to the financial results. This is where we see how Argo Group is actually doing. For the year ended December 31, 2024, Argo Group reported a net loss of $158.6 million. Remember that because of the switch in ownership, it's tough to compare this year directly to previous years. The company brought in about $1.1 billion in net earned premiums. This is the money they made from selling insurance policies. They also had $249.8 million in net investment income. Insurance companies don't just make money from premiums, they also invest that money, and that can create income. But the $249.8 million was also due to the application of purchase accounting. Finally, Argo also had a net gain on investments of $20 million. This means their investments did well overall. On the other side of the coin, losses and expenses totaled just over $1 billion. This is the money Argo paid out in claims and to handle those claims. So when you bring it all together, this gave them the loss. A large part of those losses are due to what they call prior year reserve development. This means they had to increase the amount they'd set aside for claims from previous years by $2054.9 million. That means a lot of claims were coming from old things the company insured, and they weren't able to forecast that ahead of time. The company also spent $477 year in millions on underwriting, acquisition, and general expenses. Basically, this is the cost of running the insurance business. Given these results, it makes sense that Argo is considered a non-accelerated feeler, not an accelerated feller. This just means, based on the company's status, they don't have to provide their financial data as quickly as some others do. And a large restriction involves the ability of Argo Re, their Bermuda reinsurer, to pay money upstream in the structure to its parent. The Bermudan regulatory bodies are strict and require them to be stable. As you may remember, there were some pretty significant tax changes that the OECD proposed in 2021 and that some countries are starting to go along with, the company doesn't anticipate the C Act to materially impact the aggregate tax liability and the effective tax rate. The rest of the report is filled with lots of standard business language. Some of this includes there were no unresolved staff comments from the SEC. That's good information about risk management and strategy regarding cybersecurity, our discussion of companies' properties being adequate information about a court case that has been dismissed that the Come At Me met SEC's requirements. One thing that may be relevant to you involves the company's information security. The Chief Information Security Officer and the Chief Information Officer are responsible for the cybersecurity strategy and report on them regularly. So what's our take after decoding all of this? Kyber Group is navigating a tough situation. The merger with Brookfield Wealth Solutions is intended to shore up stability. The management team is working to address past missteps, but uncertainty remains that however the road ahead won't be easy. Ratings agencies will continue to scrutinize them. Tip in short, I would say this is a company that may be a little weak. Thanks for watching. If you found this breakdown useful, hit that like button and subscribe for more corporate decodes. Let me know in the comments what companies you'd like me to analyze next.